Hello and welcome friends. Let us take a new case in the chapter marginal costing. Selling price rupees 20 per unit, variable cost rupees 12 per unit and fixed cost rupees 1,20,000. Number 1, find out PV ratio and break-even point. That means we are going to find out the break-even sales quantity as well as break-even sales value, because both are possible since there is information regarding selling price as well as variable cost both per unit. Number 2, if the company wants to earn profit at the rate of 15% on sales, then what should be the sales? Ignore tax. Even if it has not been given ignore tax, we always ignore tax because in costing, tax is never considered as a part of cost. So the formula of sales, in the formula of sales, profit means profit before tax, or say profit before interest and tax, because in cost sheet we never consider the interest, financial expenditure as well as the tax. Number 3, if the rate of tax is 40% and the company wants to earn profit after tax at the rate of 15%, what should be the sales? Now this is a typical case, because in formula we need to substitute the profit before interest and tax. Since we don't know the amount of interest, we should at least substitute the profit before tax. The rate of profit 15% is profit after tax and the rate of tax is 40%. So first of all we need to find out the profit before tax, but without finding that we can also find out the sales quantity or required sales. Number 4, find out the shutdown point. This is actually a point of short-term decision making or decisions involving alternative choices. But since it is directly related to marginal costing or break-even analysis, we are going to cover this point. Find out the shutdown point if the fixed cost to be incurred in case of close down for 1 year amounts to rupees 40,000. But first of all, let us find out the first answer, PV ratio and BEP. To find PV ratio, first we should find contribution margin, that is selling price minus variable cost, both per unit will give us the contribution per unit, that comes to rupees 8 per unit. So now we can calculate PV ratio by substituting the contribution and selling price both per unit in the formula. 8 divided by 20, that is 0.4, or more precisely 40%. PV ratio is 0.4 or 40%. The interpretation of 0.4 is if sales revenue is rupee 1, 40 paisa goes to contribution, or otherwise whatever the sales revenue is, its 40% is profit volume ratio, or more precisely the 40% of sales revenue is contribution. Now BEP. BEP means break even point, that can be in terms of quantity as well as value. We need to give both the answers. Break even sales quantity equals to fixed cost means total cost divided by contribution per unit, that is 1,20,000 divided by rupees 8 per unit. So it comes to 15,000 units. Break even sales quantity of this company is 15,000 units. Whenever they reach 15,000 units, the contribution will be sufficient to recover the fixed cost of 1,20,000. In other words, the sales beyond 15,000 will now start to generate the profit through contribution. Break-even sales value will be 15,000 units into rupees 20, the selling price. So it will be rupees 3 lakh or 300,000. But in other way also, we can calculate the break-even sales volume by the formula, total fixed cost divided by PV ratio. That also gives the same break-even sales value, rupees 1,20,000 divided by 40%. So 1,20,000 is 40% of rupees 3 lakh. So we can say that whenever the sales are rupees 3 lakh, its 40% will be contribution 1,20,000, exactly equivalent to fixed cost. Now we have recovered the fixed cost fully. In this lecture, that's it. But in the next lecture, we are going to learn the calculations of required sales through percentage of profit. We are going to consider the point of tax, etc. Thank you very much.